Hello, and welcome to another episode of the Market Snapshot series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So today is a new day where we basically look at the markets. There is quite a number of developments of another episode of the Market Snapshot series. Apologies for that. So there's quite a number of developments that have happened in the markets since yesterday. And this could guide the progress of the markets today. So before I make any progress, I would like to begin with a mic test. So if you can hear me clearly, can you type hi on the live comment section? And these will confirm that everything is working just fine. So hello, Philip. I can see you're already in the house. Hello, Charlie Genius. Thank you for joining the session. Awesome. So there's quite a number of things that we will be expecting in the week. And among them is a flurry of speeches from FOMC members, including Jerome Powell himself. And this is expected to cause some good volatility in the markets. So since this morning, we heard the FOMC member Neil Kashkari issuing a speech. This happened at 1 a.m. And one of the key highlights from the speech by Kashkari is that the resilience of the US economy, as well as the strength or the tightness of the labor market, may necessitate for the Fed to go for another interest rate hike. So with this sentiment being passed along by the FOMC member, then it implies a possibility that we could continue seeing a stronger dollar as investors continue betting on the potential for another rate hike by the US Fed. So as a result of this, we are seeing a much stronger dollar this morning, and this could continue being the theme of the day. So later on, we had Japanese data coming in. So we had the SPPI, which is basically the change in the price of services purchased by corporations. It was up 2.1%, which is higher than expected and than the previous reading of 1.8% and 1.7% respectively. So what this basically means is that forward prices are expected to be higher, so more pressure on the CPI number for the next month. So for Bank of Japan, CPI, it was higher than expected. Core CPI came in higher than expected at 3.3% compared to the expectation of 3.2%. And of course, the previous reading was at the same level of 3.3%. So this basically means that inflationary pressure continues rising in Japan, and this is not consistent with what the Bank of Japan is looking to achieve. Remember, their goal is to get inflation back to 2%. So later on in the day, we'll be looking at the results of the 10-year bond auction in the UK. We'll be looking at the CB reading index for China at 4 p.m. S&P CS Composite 20 Housing Price Index. This will be at 4 p.m. The Housing Price Index, this is the overhead number or the official number, still at 4 p.m. Then at 5 p.m., we'll be looking at the CB or Conference Board Consumer Confidence Survey. And this is expected to be weakening compared to the previous reading. Then we'll look at new home sales in the US, which are also expected to slightly weaken from the previous reading of 714K. Richmond Manufacturing Index, as well as another speech by yet another Fed member. In this case, we'll be looking at the Bauman speech. So clearly, the major news for the day will be the CB Consumer Confidence Survey, and of course, the S&P Composite 20 Housing Price Index. So housing prices have been on a decline for quite a while now. So we'll be looking to monitor the housing market closely in combination with what's happening with new home sales. This will give us information to know how to trade the dollar. So clearly, if there's a new home sales, basically it means that consumers are able to purchase even more, which basically means that there is more supply of dollars, which tends to be negative for the dollar. But then if we see a much weaker home sales and much weaker, much stronger housing prices, then in that case, it would mean that there's a scarce dollars, which would mean strength in the dollar. So as we head into tomorrow early in the morning, we'll be looking at the Bank of Japan monetary policy meeting minutes at 2:50 a.m. Then the Australian CPI data. This is a year over year. We'll be expecting this to spike to 5.2% from the previous reading of 4.9%. And this is expected to be a common theme across board, where inflation is on the rise for major economies after having been going down for the last couple of months in the last 1 year. So German GfK consumer climate, this will also be released at 9 a.m. and this will be just before the market snapshot for tomorrow. So luckily, today we have two sessions. We have the current session happening right now, and we will have another session called the markets at a glance at exactly 4 p.m. So we'll be just in time to analyze what was reported at exactly 4 p.m. The CB reading index, S&P CS Composite 20 housing price index, and of course the official housing price index number at 4 p.m. in preparation for the US market open, which will be happening at 4:30. And of course, we'll discuss more on the CB consumer confidence survey and the new home sales report, as well as the Richmond manufacturing index. So knowing what we know, on the other side, there's more news currently affecting the markets. So one of the key things that are currently happening in the markets right now is the fears that the US government may be headed into a shutdown. So key question, what is a government shutdown? So shutdown happens when Congress fails to pass some type of funding legislation that is signed into law by the president. So lawmakers are supposed to pass off different spending bills to fund agencies across the government, but the process is time consuming. So they often resort to passing a temporary extension called a continuing resolution, or CR, to allow the government to keep operating. So when no funding legislation is enacted, federal agencies have to stop all non-essential work and will not send paychecks as long as the shutdown lasts. So basically, Congress has quite a number of bills that it is yet to sign into law, and without those bills, funds cannot be released. So when the deadline occurs and the government has bills to pay, it cannot pay those bills because the laws are supporting the payment of those bills are not available. So although employees deemed essential, such as air traffic controllers and law enforcement officers still have to report to work, other federal employees are followed. So under 2019 law, those same workers are slated to receive back pay once the funding impasse is resolved. So we know that this is happening right now with the US economy, and by the 1st of October, the US government is expected to go in a shutdown if the Congress doesn't pass those bills between now and the 1st of October, which is basically next week. So knowing what we know that in a government shutdown, we normally see the non-essential employees of the government basically go on unpaid leave. And this ranges from people running social welfare programs, people running historical sites, memorials, as well as museums. So all those people will be jobless up until the government gets out of shutdown. And it's not something to be worried about a lot, because in any case that you have seen a shutdown before, it was quickly resolved. So the issue is, as traders, we are concerned about how the market tends to react to this. So whenever there's a shutdown, it tends to lead to a big sell-off in US equity markets. So if you look at another article here, this is from Yahoo Finance. The worst government shutdowns in the stock market, what history shows usually happens. So markets tend to hate US government shutdowns and the uncertainty they cast on the economy and big companies. And they really hate the long drawn out variety. So this is when the shutdown lasts for longer than expected. And as a result, the markets will tend to react negatively. So the number crunching out of RBC capital market strategist, Lori Calvasina, on Monday found that in the lead up to the last 7 government shutdowns of 10 days or more, dating back to 1976, the median S&P 500 decline was about 10.2%. And we all know that if the S&P 500 is down 10.2%, then that's taken as an official correction. So a stock market correction is due, and we could be seeing some further downward pressure on US equity indices. So the largest decline of 19.8% came ahead of the government shutdown that lasted from DEC 21, 2018 to January 23, 2019. So the smallest decline in stocks tallied 3.7%, ahead of the 21-day shutdown that ended on January 6, 1996. So there's a high likelihood that most of you are not trading in the markets in 1996, but I know that for sure some of you have been trading and were present when the US went into a shutdown on DEC 21, 2018. So during the actual government shutdowns, Calvasina's team found the S&P 500 median drop was about 2%. So looking at the data back in time, you'll notice that the shutdown of 2019, it was about 7.3%. The one we experienced in 2013 was about a loss of 2%. Then 0% in 1995, 1996. Then we have negative 2% in 1990, among many others. For instance, you can see the one for 2018, 1.5%. So there are at least 2 positives when it comes to markets and shutdowns, however. First, markets often roar back after bickering politicians find agreement on thorny issues and reopen government. So the current underlying issue happening in US Congress is that on one side, the Democrats are pushing to pass excess bills that give the government more money to spend. But then the Republicans are completely against the high appetite of deficit spending by the current administration. So they are not in support of the current bills that are basically creating more deficit for the US government. So they are fighting to get the government to be controlled in terms of how much it is spending on various programs. So in the 12 months following a government shutdown of 10 days or more, the S&P 500 gained a median of 18.9% according to RBC's research. So normally, after the big drop in prices during a government shutdown, the following 12 months, we normally get a big recovery, and the average is about 18.9% in the 12 months after the shutdown. So, and 2, data from Tourist Analyzing the last 20 shutdowns going back into 1976 reveals that stocks have been up 50% of the time during the actual shutdown period. So clearly, even in this shutdown, the stocks have been up for the year, with the S&P 500 making some good gains, but then the AI-driven NASDAQ having the best year of all time. So fraud politics tend to be a symptom of challenging times generally, Calvasina pointed out. The good news for US equity investors today is that the S&P 500 has already fallen 5.9% from its late July 2023 high. A 10% drop, which would be in line with the average and median pullback heading into extended shutdowns in the past, would take the index a little north of 4,100. So we'll be looking into that chart to try and establish where 4,100 is. So data analysis along these lines is critical for investors at the moment as the government knocks on the door of another shutdown. So the US government is set to shut down this coming weekend unless Congress strikes a last-minute agreement to pass a dozen spending bills. September 30 is the funding deadline, and that's basically this Friday. If I'm not wrong, let me check. This is basically this Saturday, not Friday. So during a shutdown, the government is only able to spend money on essential services such as law enforcement and public safety. Hundreds of thousands of government workers will see their paychecks delayed, injecting a fresh dose of uncertainty into an economy already dealing with the lagged effects of rising interest rates and roaring UAW strikes at General Motors, Ford, and Stellantis. So EY economist Greg Ducko estimated that $6 billion in real GDP, or 0.1%, could be cut from the fourth quarter if the government is closed for 1 week. Pros such as Calvasina contend that markets could stay under pressure in the near term as the shutdown risk grows. By the eventual deal, but any eventual deal could be met with renewed buying stock prices that have pulled back a good amount in September. So government shutdowns tend to be high profile, though low impact market events. Twist chief markets analyst Keith Lana said, while uncertainty around these events tends to heighten investor angst and add to short-term market volatility, the historical evidence suggests a minimal lasting market impact. That said, Lana added, we continue to anticipate that equities will remain in choppy waters near term as we remain in a seasonally weak period. Stocks continue to consolidate large year-to-date gains, and we are lacking an obvious near-term catalyst. So with that in mind, we know what to be focused on today in the markets. So remember, yesterday we identified the large potential trade for the day to be USD JPY currency pair, which basically broke above last week's high and continued trading higher for the rest of the session. So USD JPY has continued moving even higher this morning, especially after Neil Kashkari's speech. But then in the last 1 hour, we have had this particular pullback. So now that we are seeing a pullback here, remember, the idea is to continue trading higher since we have a breakout here and the target is all the way up at 151.916 for USD JPY. So before we get to that, we know that there's often some kind of pullbacks happening in the charts. So these kind of pullbacks often represent opportunities for you to buy at lower prices. So even in this case, as we see prices moving back downwards, this should not worry you a bit. The idea is to look for weakness in this bearish momentum and then go for a bullish position, trading the divergence between the Bank of Japan and the Federal Reserve Bank of the US. So this pullback is very much welcome. And once we see evidence of buyers entering the market, then that's when we squeeze in our bullish positions. So the dollar index managed to break above this area here yesterday, and today continued moving higher before pulling back in the last 1 hour. Yes, we are almost back at the open of the day, but then I expect the dollar to continue being strong as investors continue betting on another rate hike in the US. So at this point, we know that a lot of time that I've been talking about interest rates in the US, majorly I've been trying to anticipate whether the next rate will be happening, whether there will be a pause and such information. But now I think it's time we start thinking about interest rates holistically. So even if the US doesn't hike interest rates at the current level and holds interest rates at that level of between 5.25% and 5.50%, that is still significantly a high inflation level, a high interest rate level that basically drives more funds into the US as investors look to take advantage of short-term US equity treasuries. So US treasuries are giving such a good return, with the 10-year being above 4.6% and the 1-year treasury being above 5%. That's considered a risk-free return for majority of funds. And in that case, you find that it's very hard to convince an investor to invest in an emerging market or a frontier market bond compared to a US market bond due to the low risk nature of the US economy. And of course, knowing that the dollar is currently pretty stable against other currencies. So by investing in a US treasury that is yielding 5%, and the dollar is gaining against other currencies, then it basically means that it's easier for other investors to borrow at low rates from other economies and invest at higher rates in the US and get an almost risk-free return. So this has led to more money moving to the US, buying these bonds and driving the dollar scarcity. So knowing that basically tells you a whole lot more. So even if the Fed was not to raise interest rates and kept them there for, let's say, the next 12 months, that would be pressure enough to strengthen the dollar against other currencies. And I expect this particular trend to continue. So as for pound USD, it's making an impressive recovery this morning as we enter into the London session. But then you can see the overall momentum is bearish. So it's a bearish momentum that is getting ever stronger, resulting from whereas the interest rates in the US remain high, and now Fed members are already supporting another rate hike. So as a result, we are continuing to see the pound weakening against the dollar. So you can see that after this trend line was broken, there has been an almost straightforward acceleration of the bearish movement here for the last 2.5 months. And I'm talking about the month of July, August, and now September, where the pound is continuously losing to the dollar. So in this case, it means that anytime the market is making an improvement and pushing further upwards, then it basically represents an opportunity to go short yet again as we continue betting on a stronger dollar. So there is a trend line that is appearing on the 15-minute chart. So if I was to clean my chart and then zoom out here, let's close this, then you can already see that this is a prevailing theme for the last couple of days. And there's a good chance that it could continue dominating market sentiment for pound USD traders. So once the market gets to this trend line, then this is the area to start looking for potential sell opportunities in the pound USD pair, as long as we continue seeing a strong dollar in the market. So for Euro USD, it seems like a market that is trading sideways for a while and then making a break downwards. Right now, it seems like the market is pulling back to retest. So we have seen this theme continue for quite a period now. So moving on this channel, breaking down, then rising here, if you are to use trend lines, you would identify that it was yet another channel where the market was finding resistance here. It was finding support along this route here. Then another break downwards. Then it trades for the 3-day sideways, makes a pullback, and now it may be consolidating again in preparation for another sell-off. So it seems like a continuous theme where the Euro USD seems to be going further back downwards. And now the market has just bounced from the lower side and could be headed further upwards for a while before we identify another short selling opportunity. So the overall prevailing trend seems bearish to me. And I think it's reasonable for anyone else to see that this momentum is expected to continue. So yes, for now, the market is spending more time on the lower trend line than on the upper trend line, meaning that anytime the market gets closer to the upper trend line, investors are more than ready to go for another short selling position. So while the Euro USD may seem pretty much bullish right now, the better idea is to be patient and wait for a short selling opportunity. So going forward, looking at USD CAD, we can see that the market is currently trapped in this consolidation momentum here. So I'll be using the 1-hour chart to illustrate this. So a big bearish momentum where the dollar was losing to the Canadian dollar. But then over the last 5 days, we have found the market finding support along this particular trend line. I remember drawing this during the market snapshot yesterday. And as you can witness, it has served very well as a very strong support point, supporting the bounce in prices towards yesterday's high. And now potentially we could be seeing the dollar continue to push against the Canadian dollar and maybe even get to last week's high of around 1.35224. But this trend line here is the determinant resistance, and this other blue one is the determinant support. So as for gold, we continue seeing this downwards pressure. From what we are seeing here is a market that was pretty much bullish, and now it's pulling back downwards, and it's now beginning to shape up, forming what looks like a longer term triangle on the 4-hour chart. So if you are to think of this market this way, then find that as our support area. And then on this other hand, you have this longer term formation here as perhaps our resistance area. Then you can say gold is consolidating over a larger period of time, where overall we can say that this is the overall price action. The market is just moving sideways. It's only that the swings are getting smaller and smaller. So judging from what we are seeing on the 4-hour chart, it's pretty clear that there has been a strong rejection of lower prices, and there's a good chance gold will be bouncing and moving higher for the day. But then on the 1-hour chart, this is how it looks like. So we just bounced from this support level, and there's a good chance we'll be seeing some upside happening from gold going forward for the day, and this might be just be the trade for the day. So Australian dollar facing a very strong support here. So support happened here and then here, yesterday here, and now after attempting to break, we can see the strong resurgence here, indicating that lower prices were rejected, and there's a good chance we'll be seeing some further upside. So this might continue to be the theme in correlation with gold. And then for US equity indices, we can see what happened here, followed by this, basically indicating that this market is entering a consolidation. And of course, we know that with this happening here, what we have to do is to identify a breakout of the last 2 days of price action. So if the breakout happens to be on the lower side, we go short. If it's on the upper side, we go long. So it's so easy to identify and go for that breakout. So for the NASDAQ, it's the same kind of setup. So if you use a smaller time frame, then it's way easier to identify these swings here. And I can say definitively, that's the resistance, and the support seems to be somewhere along this area here. Sorry for that. So this seems to be like the prevailing pattern. And now the market is attempting to retest the upper trend line, but overall potential government shutdown is expected to lead to lower prices in US equity indices. So same case for the NASDAQ and of course, the Dow Jones 30 index. So clearly a very strong bearish momentum happening in US 30. So even if we see a bounce, then every investor is following up closely to see the progression with the US Congress. And if they are not able to pass these bills, then the overall expectation is some further downside in the market. So also beware that as we approach this weekend, then you should be prepared for a potential sell-off and the market opening with gaps on Monday. So big breakout happening in UK oil or Brent oil. So after swinging up, down, up, down, up, down here, we can say that the overall price action here was a sideways momentum. So I'll be using this arrow here, just reshaping it. So the market was just doing this kind of movement. But then since the breakout yesterday, there was a retest and now some further acceleration downwards. So if you missed the move, it's okay. Now the market is testing a major resistance area, which has now been turned into a support level. So this is the area we are talking about. Our market found resistance for quite a period of time. And now as the price gets to this point, you can already see a pin bar that happened in the last 1 hour. And now on this other hour, we are looking for confirmation. So if we have confirmation that buyers are entering this market and the candlestick actually closes green, then this would represent a buying opportunity for Brent oil traders on the 1 hour chart. But then we don't know this yet. So we have to be just patient and wait to see what happens to price by the end of this hour. So a close on the green would be confirmation that buyers have entered, and then we could go for bullish positions here. So European equity indices are making a strong recovery here on the current hour after having a sell-off during the Asian session. So in the London session, we don't know whether we'll be seeing some further upside or whether this is just a fake pullback and the market continues along that direction. So the overall trend has been quite bearish. So even though we are seeing the market attempting to bounce, it seems like it's something that has been happening over the last couple of days, where the market initially goes up and then makes a big sell-off, up, down, and every time we are seeing this upside momentum, it has eventually led to further downside momentum. So the overall trend is bearish. So if you are a trend follower, then the pullbacks are your friend. So in this case, if the market pulls back, then the idea is to look for another opportunity to squeeze in a short selling position. So from what we are seeing here on the 15-minute chart over the last couple of days, this seems like a consistent theme. And of course, sometimes we have trend lines within trend lines. So there's also a trend line within this trend line where we have more points being covered by the resistance. So in this case, we have two trend lines here. So it basically means that the market is operating within a cloud, and the cloud could be between this trend line and this trend line. So as long as the market gets between these two trend lines, then you are in your best zone where you're looking for another short selling position. So same case for the Euro 50 index, making a recovery, but then once it gets into the cloud, then that's where we are looking for our short selling potential opportunities. So from the 1 hour chart, this is how it looks like. So potentially our cloud will be covered by this high and this high. So this is the area here. So as soon as the market gets between this and this, then we start looking for short selling opportunities. And it's the same case for the UK 100. So UK 100 managed to trade sideways for a while. For almost 2 weeks, broke to the lower side yesterday, retested and continued pushing lower. But then here we are seeing a very strong emergence, potentially getting back into this sideways momentum. So that's it for the day. Let's see if you guys have any questions. So hi Ted, Butin, I'm seeing Mercy, Matamano, and Sinbaz. I'm seeing Peter Samuel, Agnes, Susan, and Buandawiro. Hi Joe, Amos, and Lucy. Hello Francis. From the 4-hour chart of New Zealand USD, AUD-USD, it appears these through holding their ground against the USD. Any thoughts? Yes, I think there's a strong case for strong support for the two pairs. So AUD-USD is holding this support pretty strongly. So there's evidence it has done this before. Yesterday it did it. There's also evidence it rejected this price before, and previously this was acting as resistance and support. So yes, there's a strong case that the market will be bouncing from there and potentially making a run to the upper side. And of course, for New Zealand USD, after having this channel, this pullback basically retested yesterday's low, and now you can see the market bouncing strongly, basically wiping out all the earlier losses, basically indicating that there's a higher potential for upside momentum. Hey, J-Scode, how are you doing? Random thought, DXY and WTI Brent has been weakening since KK government came to play. So in same period, cash shilling has weakened to DXY. Since the July DXY and WTI are running, is in time to earn in USD, worried about cash shilling? Yes, if you can earn in USD, you have a much bigger and better in the market. So you are basically trading a stronger currency versus a weaker currency. And given the fundamentals, it's indicative that there is a higher demand for dollars than Kenya shillings, which basically implies that the Kenya shilling could potentially continue sliding against the dollar. So far, it has been sliding at 2.3% per month over the last one since the beginning of the year. So this is projected to get us to 160 towards the end of the year. But then when you add other factors such as rising oil prices, other factors such as the interest rate that we are paying on debt, then there's a good chance that we could be seeing some much higher exchange rate, maybe 180, 190, or even 200 towards the end of the year. So rating agency Moody's said that US government shutdown would harm the country's credit, amongst dollar, gold, yen, which is the safe haven here. So the safe haven is commodities. The safe haven is commodities. So the only reason that the investors over the last 2 years have been using the dollar as a safe haven is because it had this risk-free return. So instead of speculating in a risky asset or even just keeping your money in gold, you just hold into dollars, which were appreciating against other currencies, which would earn you a forex income. And on top of that, the US government was giving you a risk-free return of about 5%. So yes, there are some risks associated with bonds, but normally in such economic conditions, it tends to be viewed as risk-free. So in this case, the US treasuries tended to be a very good bet for investors. So higher interest rates, slow economic growth, which curbs oil demand. What is your view regarding the Kashkari talk on one more rate hike and higher rates for long, tied to oil markets outlook? So the US is looking to empty its SPR reserves, or basically its crude oil reserves, and that's only a threat that it has issued because it needs to manipulate oil prices by drawing from its SPR reserves and using that to fix the gap in the market, which would stabilize prices, which is something that Biden has been doing over the last 18 months. However, this has not worked well because whenever they want to replenish the stock, the prices tend to go even higher, meaning that the US may have to buy oil at even higher prices. So now that the US doesn't have sufficient oil and the OPEC have started this war, where they are basically cutting the output to manipulate oil prices to the upper side, then the overall expectation is that the oil prices will continue rising higher. And of course, speculators are also participating in the market and creating even higher demand. And this is resulting in crazier projections with one of the top bank analysts in JP Morgan projecting that oil prices could get to $150 per barrel. So recent spike in inflation has been blamed on higher oil prices, i.e. supply constraints, no demand problem. How will higher interest rates help lower oil-driven if supply constraints are not resolved? Yes, this is a very a problem with the Keynesian economics. So sometimes interest rates are not enough to control inflation, which eventually leads inevitably to a recession in any economy that hikes interest rates so fast without solving the underlying problem. So what of gold? Gold might continue being weak, but now, if at any point there is a sudden escape away from US treasuries, then commodities are set to benefit, particularly oil, but also gold could be benefiting from this. Hello, I'm new in this space as I don't know where to start. I've been going through some notes in Forex, but I think they are no great help. Any video of your own for beginners? Yes, I have a special course for beginners. It's called Novice to Pro. It's available on the FX Pesa YouTube channel. So just go to the FX Pesa YouTube channel and then under categories, look for the Novice to Pro series. It's a 10-episode series helping you to transition from a complete beginner to a pro-level trader. Isn't that catastrophic to our import status? Yes, Kenya shilling going to 200 would be bad for the economy. In a forum on FX Pesa where I can learn how to analyze the market in detail. I've blown my account twice and need to be sure before I load it again. I think you need to go through the Novice to Pro series if you haven't. On top of that, we cover a lot of topics ranging from risk management, market analysis on the Bullish Banter podcast. So we have a podcast that is dedicated for traders. It's available on the FX Pesa YouTube channel, as well as other podcast platforms such as Spotify, Google, as well as Apple Podcasts. So make sure you just peruse through it, find the lessons you need, be it risk management, psychology of trading. We have covered all those topics extensively, and this should help you improve your market analysis tactics. So thank you guys. Thank you, Dennis Mulwa. See you guys at 4 p.m. as we prepare for the New York Open. Thank you, much appreciated, and I hope to see you then.